Hello, I'm Smits for the Finance News Network, and joining me today from Commonwealth Bank of Australia for an outlook on the year ahead is its Chief Economist, Michael Blythe. Michael, welcome back to FNN.
Thank you.
The S&P ASX 200 index gained 15.1% over 2013. Where do you see the benchmark index trading over 2014?
Well, we think it's going to move higher, maybe not quite at the sort of rate that we saw in 2013. Our forecasts have the ASX 200 about 10% higher at the end of this year, around that sort of 57.50 type number.
And which sectors are likely to support these gains and which are at threat of dragging on the broader bourse?
Well, I think if you look at what's going to be driving the economy through 2014, it's a lot of those interest rate sectors. That stimulus Reserve Bank has been pumping in is starting to fire up in areas like construction. We think that'll flow through to retail. But the other area that we're watching is going to be those sectors that are exposed to the currency. Obviously, the Aussie dollar is a lot lower than it was this time last year. That is taking some of the drag off some of those sort of currency-related areas. We'd expect to see a better performance there. What it really means in a bottom line sense is the Aussie dollar, that drop, is now playing the usual sort of buffering role it does at a time when sort of global incomes are still pretty weak. We're going to get a bigger bang in Australian dollar terms this year because of that lower currency.
So, Michael, where do you see the Australian dollar trading and ending this year?
Sure. Well, we think the Aussie dollar will end this year at around about 89 cents, so not far from where it is today. Now, that drop that we saw from $1.05 this time last year down to 89 cents now, it was largely in anticipation of that shift in those quantitative easing policies in the rest of the world. One of the ways they're supposed to work is by putting downward pressure on their currencies, the US dollar in particular. And of course, as the US dollar goes down, everybody on the other side of that has gone up, including the Australian dollar. The process going into reverse, we think the US dollar will strengthen and the Aussie dollar will be weaker as a result. But a lot of that looks to be priced in, given where the currency is sitting right now. But certainly the risks do look to be on the downside.
As global equity markets rallied in 2013, precious metal prices sank significantly. What do you think's in store for gold and silver this year?
Well, I think the big story globally, of course, has been that extreme monetary accommodation, that quantitative easing, as it's called, the major central banks have put in place. It's encouraged a lot of interest in precious metals in particular. Well, of course, we're now seeing the US Federal Reserve start the process of winding back on that stimulus. So some of the support there under precious metal prices we think will actually recede as we move through 2014.
So what price would you put on the precious metals by year end?
So we have gold prices, for example, dropping back below the $1,200 mark as we move through this year. Silver prices, we think the current sort of $20 level is probably around about where we'll end up the year as well. That sort of risk focus on those precious metals will recede, we think, in 2014.
Iron ore has seen a soft start to the year with prices hitting 5-month lows of about $130 per ounce. What's your outlook for the steel-making commodity?
Well, likewise, we think there are some further price drops to come through there. Our commodities team think we'll see the iron ore price at the end of this year at about $119. So a bit below where we are now, but it's still very high by any longer run comparison. The other thing we need to bear in mind when we're thinking about from an Australian perspective, what it means for Australian incomes really depends on the Australian dollar. And that Aussie dollar, iron ore price and gold price and silver price for that matter will be much better behaved, if you like, because of that drop in the currency.
Michael Blythe, thank you for your insights today.
Thank you.